Welcome everybody to our Working with the NPP Group series, where today I'm having a conversation with Jake Ragan, who is our lead specialist in the investment sector. If you're working with us, you've probably heard the dulcet tones of Jake's voice on the phone quite a bit. Today, thanks for joining.
Thank you, Mike. Cheers for having me.
Today what we're going to do is kick about a few discussions, questions that you guys are asking Jake on the phone, topical from a time perspective. Here at the end of June in 2022. What's on your minds from an investment point of view? We're going to answer those questions, chew the fat, probably leave you with more questions than answers, but we'll do our best. Okay, so Jake, you're probably having 5-10 phone calls a day with our investors at the moment. Talk to us about some of the questions that they have. I guess you probably spend a lot of time sort of with investors' concerns. So how are those conversations and what questions have we got at the moment?
Yeah, in terms of questions and concerns, there's a general theme running through. A lot of it, as we speak today, is around the current economic climate of the UK. Obviously, properties in the UK in the north. Things like the rising utility bills and gas and electric bills is one thing, certainly for investors who are looking at HMOs.
Yeah, I get that. Obviously, as Jake just said, HMOs, if you're investing in buy-to-let, single-let property, the bills sit with the tenant. So it's, whilst it's certainly happening, it's not a massive concern for you as an investor, as a landlord, landlady at the moment. But if you are in HMO, then the bills sit with you. So, the rise in bills is interesting. But I always think, for those of us that are new in property, you've got to understand that there's always a theme. There's always something in property that's going to throw a challenge at you. At the moment, the rise in bills and electricity costs, they're big, but I tell you, we're going to throw some of my P&Ls, my profit and loss from a monthly basis of my HMO portfolio over at you. I tell you what we see, it's marginal. It's absolutely marginal. If you've invested well in 5-6 bed HMOs, you should be cash flowing £1,000 up to £1,500 a month. I've looked at Jordan, my portfolio manager. We've looked at things. Yes, those bills have probably gone up even up to a sort of £100 a month per property. Is that massively affecting me? No, it's not. To be brutally honest with you, it's not. Yes, there is a rise there. Do these things still work? Am I still getting a great return on investment? I am. And also, I just think it is topical. It is timely. Do we think it will stay there forever? Hey, what if it does stay there forever? Will rents follow? When I bought these HMOs, the rents have increased significantly year on year. So, to take a little bit of an energy bill with it, to be honest with you, it's just not as big a deal as we like to make out.
Yeah, cool. One of the other questions I get quite a lot, people are worried about the rising interest rates, obviously lending becoming more expensive. What are your thoughts on that one, Mike?
Yeah, it's interesting, isn't it? I love it. Look, I get it. We're all looking at reasons not to, but there's so many reasons to invest in property. I suppose we spent a lot of time on that. The interest rate piece at the moment, I was on a call to an investor this morning, a good friend of mine who's buying several apartments at the moment, and he was offered a 5-year fixed at about 4.2%. So that for me, if you're a little bit risk averse and you're sort of thinking that the lending scenario scares me, there are great lending options. 4 point something percent is still very, very cheap lending, very cheap money. Do your calcs on that, and off you go. I don't know if I'd be fixing for 5 years, because I don't think that the modern economy can sustain a massive rise in lending. I don't think it will happen. We know that the base rate is creeping up. I do think that there's probably another point or two to come, but I don't think it's going to go crazy. But very simply, you've got to ride the property wave. If that is a concern for you, no worries. Fix it for 5 years right now. Honestly, you'll probably be kicking yourself in the ass in year sort of 4 and 5 when you could be getting much better lending. But that's the the risk reward scenario. So whilst I I understand that concern, for me it's not it shouldn't be a barrier to entry. It's just something to factor in along the way.
Yeah, cool. Something I hear quite a lot when I'm on investor calls is, should they be timing the market? Should I or any investor be trying to time the market? Now, there's an elephant in the room, isn't there, at the minute in the media, that there's potentially going to be a crash. Don't think anyone really knows, but what are your thoughts on that, Mike?
We're putting this out there, aren't we? So, I mean, we're at the end of June 2022. I don't mind. I think, global economics it's an interesting time. Of course, we're coming off the back of COVID and all the money that was thrown at, certainly in the UK, through COVID. So, inflation being what it is, we can discuss that in a few minutes, but we see, don't we, here, we're probably doing 15, 20 transactions a month. So we're right at the coal face. If there is a slowdown, if there is an increase, we see it probably first, or people in our industry see it first. If I'm honest, end of June 2022, it slowed. From speaking to the guys and who are pounding the streets and finding the deals, for me, the market slowed already. It hasn't dropped, but let's just study that for a second. As soon as it slows, that means that vendors that were sort of fighting people off and picking investors against each other or home buyers against each other, and the prices then rise because of what the price that people are willing to pay. As soon as the market sort of slows down and vendors are only getting one or two offers, then that aggressive growth stops. I think the aggressive growth has stopped, and I think therefore press is usually a couple of months behind due to the way that they look at the data. So I think that, where are we, end of June, July, I'm going to predict sort of beginning of September, a lot of noise, slowing down, property market slowed down, it's plateaued, here comes the drop. My gut feeling here is, because of the aggressive growth we've had, that we will see some form of a drop. I would guess around 5%. That's still going to leave us about 15% above where we were 12 months ago. So that's my gut feeling. Timing the market, though, is, for me, a bit of a fool's game if you are in cash flowing rental stock that you're going to hold over time. I know Jake's a proper stato, so we've been through the numbers, and when you actually look at it, people try desperately holding on to their cash to try and time a market with inflation. It's eroding. You can be in property, you can be cash flowing, you can be gaining the capital appreciation while it's there. So timing the market in rental property to hold long term to cash flow and gain capital appreciation is a mug's game. What do they say? Time in the market rather than timing the market. And that's exactly where all the wealth is built in property. So for me, if that's your game, if you're an investor and you're trying to buy buy-to-lets, HMOs to hold long term, get yourself in and ride that wave. As long as you don't sell in the 5-10% dip or whatever it's going to be, it's not really a massive issue for you. We've seen so many people sort of hold on to their cash, and probably the last thing I'll say on that is the press obviously escalate and dramatise everything, so that's what sells papers. But also, if we're talking about developing on scale, whether that be new house builds or big apartments, and your strategy is put a lot of cash out there on the table in hope to claw all that cash back when you're selling, then a market drop is a big concern for you. If the market drops 10%, and you're a big house builder working on an 8% margin, then you're in trouble. So this is big business for the UK. But don't get conflicted with what the papers are saying, and if that was your strategy, with you trying to build a buy-to-let portfolio to secure your financial futures and your wealth long term. It's actually kind of got nothing to do with it, to be honest with you.
Yeah, brilliant. The final one, more of a general question around economics currently in the UK. Obviously the rise in inflation, as we speak now, it's roughly around 9%. What are your thoughts on people who are kind of waiting out the storm at the minute, obviously for this crash, but also the impact of inflation on their money if it's sat in the bank? And what are your thoughts on investing during this time as well of high inflation?
Yeah, I mean, I think we publicly sort of said on all forms of media, inflation is a massive issue for you if you're a saver. You can't save your way through to wealth when interest rates are lower than inflation. It's impossible. We can't do it. So, this generation of savers, and that's what makes us comfortable, and actually we can compound our wealth in the bank. Inflation is a massive issue for you. If your cash is in assets, property, cash flow, capital appreciation, like we just discussed, if there is a dip, you're wading that out. You're not selling in a crash. You're holding and cash flowing. There's, we could go on forever, but that's my take, and I just think I feel quite fortunate that our expertise is in property, and property seems to be the safest place, for your cash to be at the moment. But you're the economics master, to be honest, mate. I'm just some sort of property buffoon. What's your take?
I think what I find interesting is that people, obviously, you look at debt. There's good debt, bad debt. Obviously, racking up your credit card bills is probably bad debt. But during a time of obviously inflation, what a lot of investors don't consider is that if you're lending money from the bank at 4%, which is still a really good interest rate, that debt, say you lend £75,000, £100,000, the inflation as that rises, it actually diminishes the amount of debt or the worth of that debt over time as well, which obviously is a good thing. So I don't see this time with high inflation as a bad time necessarily to borrow money for property.
It's amazing that, isn't it? It's a great point. It takes probably a little bit of getting your head around. If you're borrowing good debt, that's debt that's serviced by, in this scenario, your tenants, and leaves you with cash flow, that if we borrow £100,000 at 4%, but inflation's at 9%, just give you a second to get your head around that. So, for me, the rules of the game don't change, and that's what I love about property. Yes, there is a strategy for each market, and yes, if you're putting a lot of cash on the table to sell, and market dip can massively affect you, then that's something to consider. But if you're in this game to hold property long term, cash flow, capital appreciation, legacy wealth, which is kind of what we're all about here. Leaving something for these guys and trying to change your financial position. Then time in the market, bit of a mug's game. Action is what breeds success. And whilst it's not about being silly and just throwing money at property, you've got to do it in a calculated way. You've got to do it with the right team around you. But trying to time this piece, especially with everything else that's going on from an inflation point of view, just seems a bit daft to me. Great, well hopefully you got some value from that today, our ramblings on the marketplace at the end of June 2022, inflation and all the economical factors around that. Jake, it's been a pleasure. If the guys want to get in touch and sort of pick your brains and move forward with us at the NPP Group, how do they do that?
Yeah, all they need to do is click the link below this video and can set up a strategy call with myself or one of the team members to talk through their investments and what they're looking to do.
Love it. All right, guys, well, hopefully we've added some value to you. Please subscribe, like, share, and all that good stuff. And we look forward to speaking to you again real soon.